Understanding India's current account balance, recent trends, and key components. The current account balance, or CAB, reflects India's financial inflows and outflows. It is a key component of the balance of payments. The balance of payments consists of two main accounts, the current account and the capital account. Let's look at the recent trends in India's current account balance. In the fourth quarter of 2024, India recorded a current account deficit of $11.5 billion. This was slightly higher than the previous year's figure. However, the first quarter of 2024 saw a surplus of $5.7 billion, marking the first surplus since June 2021. The current account balance consists of four key components. First, trade in goods, which includes imports and exports of physical goods. Second, trade in services, which includes IT, tourism, and transportation services. Third, primary income, which includes investment income and employee compensation. And fourth, secondary income, which includes remittances, foreign aid, and grants. Let's examine the first component, trade in goods. India has consistently maintained a merchandise trade deficit. In the fourth quarter of 2024, the merchandise trade deficit widened to $79.2 billion, compared to $71.6 billion a year prior. The second component is trade in services. India has a strong services sector, particularly in IT and software services. In the fourth quarter of 2024, the surplus from services increased to $51.2 billion, up from $45 billion the previous year. This increase was driven by exports in business, computer, transportation, and travel services. The third component is primary income, which includes investment flows such as foreign direct investment and foreign portfolio investment. In recent reports, the primary income deficit increased, reaching $16.7 billion. The fourth component is secondary income, which primarily consists of remittances from Indians working abroad. The secondary income surplus, which includes remittances, rose to $33.2 billion. Personal transfer receipts, mainly remittances from Indians employed overseas, increased to $35.1 billion. To summarize India's current account balance, a deficit means India is a net debtor to the rest of the world, while a surplus indicates it's a net creditor. In the fourth quarter of 2024, the current account deficit stood at 1.1% of GDP, amounting to $11.5 billion. The first quarter of 2024 saw a surplus of $5.7 billion, marking the first surplus since June 2021. India's strong services exports and remittances help offset the persistent trade deficit in goods. Several factors influence India's current account balance. Let's examine these key determinants. The performance of India's current account balance is influenced by several factors. Exchange rates significantly impact the balance. A weaker rupee makes imports more expensive, increasing the import bill and potentially widening the deficit. Foreign direct investment flows play a crucial role. Decreasing FDI inflows can put pressure on the current account deficit. As shown in this chart, countries like Mauritius, Singapore, and the UK are major investors in India. Gold imports significantly affect India's trade balance. Higher gold imports can widen the current account deficit, as gold represents a substantial portion of India's import bill. Remittances from Indians working abroad are a significant positive contributor to the current account balance. In recent quarters, personal transfer receipts increased to over $35 billion. Trade policies and export composition are vital factors. As shown in this graph, IT and software services form the backbone of India's exports, with telecommunications, computer, and information services valued at over $125 billion. Finally, fiscal deficits have a significant impact on the current account balance. Higher government spending relative to revenue can drive current account deficits, as seen during the 1991 balance of payments crisis. Now let's look at the future outlook for India's current account balance. Looking ahead, Trading Economics projects India's current account deficit to trend around negative $7.6 billion in 2026 and negative $6.5 billion in 2027. The current account to GDP ratio is projected to reach negative 1.50% by the end of 2025, negative 1.70% in 2026, and negative 2.0% in 2027. The World Bank expects India's current account deficit to remain around 1 to 1.6% of GDP up to fiscal year 2026-27, supported by strong services exports and expansion of medium and high technology goods exports. Exchange rates will continue to play a crucial role. Currency fluctuations significantly impact import costs and export competitiveness. Diversifying the export base and enhancing export competitiveness are crucial for improving India's current account balance. Additionally, keeping an eye on global factors like borrowing costs and geopolitical tensions, which can affect FDI flows, will be essential. On a positive note, ICRA expects a current account surplus in the fourth quarter of fiscal year 2025 due to increased exports and a healthy services trade surplus.